There's risk in every deal, right? Every deal has risk, and it's important that you understand what the risks are. Typically, we do different assets. So we're doing, we've had over 12 million raised for ATM machine funds, right? That's a very different type of asset, very consistent cash flowing deal. But there are risks, in that. There's risks in car washes. There's risks in oil and gas, which we're doing all of these. And so I tell people, in general, this is the risk that I see in this deal is this, and I'll just tell them. And I say, but you have to get comfortable. And I think whatever deal you're investing in as a passive investor, you've got to just really identify what are the one or two primary risks that you're seeing. And if you don't see them or you don't understand them, you probably don't understand the deal well enough.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
All right, welcome back to another episode of the Brenneman Blueprint. Have Bronson Hill on the podcast today. So Bronson's the founder of Bronson Equity, and he's a multifamily investment professional. He's done over 200 million of real estate deals, and he's raised over 35 million from individual investors. And he has a lot of experience talking to LPs. He told me before he's spoken to over 2,000 individual investors. So I want to pick his brain on everything he's learn from those conversations and hear what's going on in his world today. So welcome, Bronson.
Awesome. Excited to be here, Drew. Excited to be on your show as you were recently on mine. So looking forward to it.
Yeah. Thanks for having me on your show. And I think, why don't you just, if you want, just kind of bring us up to current day. Tell us how you got to where you are today in real estate.
Yeah, so I'd always wanted to do real estate because I like the idea of, generating wealth. And so I had bought a house and kept it as a rental house, bought it kind of after college, and I took a job in another state. So kind of held on to this property. And eventually I had said, well, I want to do more. I want to start to scale more. So I started buying single family houses in another state. And it just really wasn't getting me to my goal fast enough. On paper, it looked great, but the numbers deals weren't performing the way that I would have hoped, right? The expenses were always higher, and I was buying in Cleveland suburbs or something. So they weren't like really nice areas. They were really, if you want a deal not to go, just buy in an area that's maybe not great tenants or not a great area or other challenges. And so I had a relative come to me. There's a saying that when the student is ready, the teacher appears. And so I had a relative I hadn't seen in a while who did real estate. I know that he was very successful. I didn't know what he did. And I said, here's my plan is to get 30 of these houses and to, retire, quit my job with passive income. And at the time I was a medical sales guy. I was making over $200,000 a year. So I had a great job, but I wanted to have more control over my time. And so I said, well, my goal is to get all these houses. And he said, well, that sounds like a lot of work. Why don't you do multifamily? And I said, like apartments? I was like, well, I don't have the money for that. And he said, well, you can raise the money. So he taught me about something called syndication, which is raising money from other investors. And so I started a meetup in my area. I started reading everything I could about real estate and particularly multifamily, started a meetup and basically found my first investor there and then made a partnership about 6 months later. I basically joined somebody who had a huge network and was helping train people how to do their own syndications, how to raise money, how to do all this, but they were having trouble on their own, doing their own deals. So I came on board and said, what if we did this? And we had somebody taking calls and doing podcasts and just kind of helping to kind of drive this. And so I did that. And over the next 18 months, we raised $15 million together. And so that kind of really got me in the industry. Like I said, it's about 1,500 calls now, but I had about 1,000 calls over those first 18 months with high net worth investors. And so it's just, it's been a great experience. There's been challenges that have come up, but I was able to leave my great corporate job about 2 years ago, I think 2 years ago this month. And so, and I'm traveling, I've traveled 4 or 5 times internationally this year, and I've got a couple other big trips coming up. So it's been great to have flexibility over my time, which is what I wanted.
Yeah, that's exciting. Was that your ultimate goal, would you say, just where you wanted the flexibility, or is more about passive income? I mean, what would you say was the biggest underlying thing?
Well, I think it's both. I think it's, when people say, hey, I want financial freedom, but really, what does that mean? Most people, when they really break it down, is that most people want to have expenses covered, but they really want to have freedom over time, right? If you have enough coming in that where you're covering your rat race number, if you will, right? The number that's your expenses, what that gives you is the ability to work or not work as you like. And so that's that's really what I wanted. And so to me now, yeah, it's having, there reached a point where I was able to cover my living expenses, and then beyond that, and just be able to do more deals. And I just think it's so much fun to be able to do your own thing, and to be able to, I've always valued freedom and just be able to be creative. And I find I'm able to do that with our stuff with Bronson Equity.
And then how were you able to make the transition? This is a step that I want to try to drill into, where, so you went from, making a lot with the consulting job. So then how were you able to step out of that? Was, cause it probably wasn't just one day you woke up and said, all right, I'm going to go into this real estate thing. It was kind of doing both at the same time for a little, or how did you navigate that?
Yeah, I wish it was one day I woke up and I just told the boss, screw you, man. And then just it didn't happen like that. There's different people have different opinions on this. Some people are like, they hear about, they go to some seminar and then take out a loan to do the mentorship program or whatever. They've got no money at all, and they like burn the boats and they quit their job. And like, that's one way to do it. Other people are like a month or two short of retirement, and they're like, I quit my job with financial freedom. And you're like, dude, you're almost retired anyway. But so it's like, when do you actually leave? So to me, I knew I really wanted to leave. I was approaching 40, and I thought, man, I just really would love to. I knew if I didn't do it, eventually I'd be older. I would regret not really going for it. And so I reached a place where, I started doing the real estate stuff on the side, started building, kept it pretty separate from my regular job. Then as I was scaling up, I kind of dialed down I had a job that was a little flexible. So I was able, instead of doing 40 plus hours, I was able to dial it down to 30 or maybe 20 hours a week. So I was able to dial it down a little bit. And then it was hard for me because I'm a achiever. So I want to be a rock star sales rep or consultant. So like, I had to be like, oh, it's okay. I had to like counsel myself. It's okay not to be super in this area because my future is over here, right? It's over here. And as I started to really develop my partnership with the folks I mentioned, I was with them for 18 months, and we did all these big deals. We raised 15 million, and then we raised so much money. I think the last two we raised about $8 million. They kind of said, we just don't really think that this is, we appreciate everything you've done, but maybe best if you kind of did your own thing, right? So we can hire somebody who's in investor relations. They were just paying me so much money to do this, and I get it, right? You're the agreement you have, you're paying somebody so much money, and so I was a little bit upset at the time, but what it allowed me to do was to really try to launch and really create my own brand, which was Bronson Equity. And I knew that as I did that, there would be some risk that maybe I could lose my job, and whatever. But I was kind of like, you know what, this might actually be a good thing, right? I can actually create this and be kind of this beautiful destruction. And it kind of happened. Like toward the end, I had basically started creating posts on, I had a team kind of creating posts on LinkedIn and Facebook. And I realized now there's actually a way on LinkedIn you can block your boss from seeing your posts, which I didn't really know you could do that, or you could
without just blocking them outright.
Yeah, well, you can block them, and when you block people, it doesn't actually show up that you've blocked them. It's just they can't search you, they can't find you, and so that's a little tip for anybody who's doing that. But regardless, at some point, if you're going to take the leap, you got to take the leap. I really had a hard time because my whole family, nobody's really entrepreneurial. And so they're like, why would you leave your great job? It's the golden handcuffs. Or why would you ever leave? And so I have this group of entrepreneurs that I was meeting with for a year. And I just said, hey, here's the business. Here's what I'm doing. Here, I want to leave, but I'm scared to leave. What if something doesn't happen? They, without exception, they were all like, you should leave your job pretty much as soon as possible. And if it doesn't work, you could always go back. Like you have like all this experience.
That is what I always say. Yeah. I'm glad that you said that, because that's the same thing I always say too. Just worst case is you probably can't go work at the same exact company, but you could just go work for your competitor, and
Totally.
You can sell that to all the doctors. So that's great, and that makes a lot of sense. And I think what were some things then you learned in all those conversations with the passive investors, with the LPs then?
I mean, there's a lot of takeaways from that. I think as the more conversations you have, I think when you're first starting out, it's kind of like, I don't know, like, how is this actually going to go? You have a conversation and you're like, I don't really know where this person's coming from. So, the first, few conversations, you're really stumbling through it. By the 50th conversation or the 100th conversation, you really know how to have that conversation, and the big thing I've realized from those conversations is just really trying to figure out, how did this person find out about you, and who is this person? Like, and I always ask a question like, well, tell me a little bit about your background, your work background, and your investing experience, right? So what they're going to do, they're going to start talking. They're going to say what they do for work. So you're going to know, okay, if they're a doctor, or if they're what's their background. It's going to give you information, just kind of how they would approach things. And then also with investing experience, have they only done stocks? I remember I had a call with a doctor that his net worth was $5 million. He had a money person, only bought stocks and bonds. So that's going to be a much more basic conversation around what syndication is, how it actually works. Here's the process. And they're going to have to get comfortable with, is this not a scam? Is it is this an okay thing to do? Versus somebody who's invested in 10 or 20 syndications, and you're gonna have a conversation about cap rate, reversions and other what's the assumptions in these specific areas. So it's just, finding out who that person is on the phone, finding out what they're looking for, and then really finding out, okay, would this really help them to get where they want to go? So I think those are things that are important, but it's always amazing too when you start developing an investor list, you start providing education just as you're doing, Drew, and then you put a deal out there, and these people that they hey, I'm interested in joining, and it's like it's a cool experience to have people want to join in what you're doing.
So most people, what were they that were looking into investing passively? What were they looking for, would you say?
I would say there's several main issues. One is reducing taxes. That's a big one. Will this help me reduce taxes? We don't provide specific tax advice, but real estate provides a lot of depreciation, particularly syndication and multifamily provides a lot of depreciation, at least through the end of this year. It will go down a little bit next year, but it's just a great way to reduce investment gains from a taxable basis, either defer or completely write off. And so that's a need. Another one is, just learning about passive income. So a lot of people have a rental house or 2 or 3 or 5 or 10. And I tell them, hey, if you want to be a passive investor, you have 2 houses, and how's that working? If you wanted to put 10 times the amount of, houses out there, let's say go from 2 houses to 20 houses, could you do that? And if the answer is no, well, then you're not really passively investing, right? I know people that are invested in over 70 passive deals, which to me is too many, but some people do it. Like, they get in a lot of deals. So you're doing the work on the front end where you're vetting the deal, you're vetting the operator, and then, you keep an eye on the statements and things, but it's much more passive. It's not fully passive, but it's more passive. And so I think there's a lot of people some people think, starting an online business or having a rental house or a vacation rental or an Airbnb, those are actually not passive investments, right? So I think it's just, getting into what really passive investing is. And then, I think over time, it's really, it is getting people comfortable with the asset so that they not only try it, but over time, they're comfortable putting more and more of their net worth into different deals, and they're willing to scale. Because again, everything sounds crazy until you do it. And then once you see, oh, this actually works. Wow, this is amazing. And the light goes on, and then they start deploying more and more capital to things that we're doing.
And then, because I have a lot of these same calls, so I'm just very curious what you're. And then they would say, what's the catch? Or I don't get it. Like, what's the downside? What do you say?
Well, I tell them, I said there's risk in every deal, right? Every deal has risk, and it's important that you understand what the risks are. Typically, we do different assets. So we're doing, we've had over 12 million raised for ATM machine funds, right? That's a very different type of asset, very consistent cash flowing deal. But there are risks, in that. There's risks in car washes. There's risks in oil and gas, which we're doing all of these. And so I tell people, in general, this is the risk that I see in this deal is this. And I'll just tell them. And I say, but you have to get comfortable. And I think whatever deal you're investing in as a passive investor, you've got to just really identify what are the 1 or 2 primary risks that you're seeing. And if you don't see them or you don't understand them, you probably don't understand the deal well enough, right? So I think that's really important to learn and see. And I think, you should think about it yourself. Then you should ask the operator what they see it as. And if they ever just say, oh, there's no risk, everything's secure, whatever, it's like, well, everything has risk, right? So it's just, I think I appreciate operators that are like, well, here's the biggest risk that I see, or here's the couple risks that I think about, right? And here's how I think they're managed, but they are risks, so I think those are important.
Definitely. And in general, if we're just talking generally, like, what's the catch? Because it sounds great. There's cash flow, the returns are high, there's tax breaks. Like, I don't get it. What's the downside? I always say, like, it's the fact that it's not liquid. If you could, this is an investment for people who you don't need the money back for 5 years or sometimes longer. So that's the downside is, if you could just press the sell button, like in your, like with stocks, like you can get the money out quicker, there probably would be less cash flow and the returns would be lower because more people would be in it, kind of driving up the prices, if you will, and making the return smaller. So I always say that's just not talking about a specific deal, but just like multifamily, or just private real estate in general. I always highlight that because people will think like, I don't get it. How's there's not like a big, like what's, the returns are high, there's cash flow, you get the tax breaks. Like I don't get it. There should be something like downside. And that's a big downside. So it's really more, this is for wealth building, or kind of how you were talking about for your personal situation where you're trying to build cash flow, and, a second income stream, but if you needed to just access it all, you couldn't have.
Yeah, and it's interesting. That is a disadvantage. I mean, Warren Buffett would say that's also an advantage too, right? Because if you could buy and sell your syndicated investment, or it was priced every day as stocks are, people might panic and sell, right? So it's kind of an advantage and a disadvantage, right? But I think that for a lot of these investments, it's amazing when you get out of Wall Street and you get into Main Street. It's like, in a way you get penalized for having liquidity. So one advantage, disadvantage is this is not as liquid, but in a way you don't get a quote every month, every year, it pays out what it pays out. And it's, people can potentially sell, right? They can potentially sell their interests. It's harder, and usually it's at a discount and things like that. And operators can buy out. But, I think that's one of them. I think, there are the risks are the operating team, who is the team operating it. And that's where the diligence goes into it. The market itself, whether it's, the market we've bought in Jacksonville, Florida, or areas you buy in Chicago, or it could be, the ATM machine market, or this specific oil and gas market, or the operating team for that. And then also how the deal actually functions. And a lot of times, if the operator is not the right operating team, they're going to make more mistakes. Like you talked about this on your interview on the Mailbox Money Show. It's just like, if you're in a new market, you're going to learn, there's going to be a lot of learning that's going to happen, right? You're going to just, different prices for things, or working with certain partners. And I've seen it, you may have seen this too, but operator is really good in one area, even a property manager is good in one area. And then you take that property manager and you go 2 hours away and they're no good, right? Because they don't have the local context. They don't know, their contractors don't want to drive 2 hours away to go service this stuff, right? So I think it's just really trying to get your head around, every deal is different. What are the risks you see, and what's the best and worst case scenario here? And a lot of times for people, it's you can get stuck in analysis paralysis. So it's not getting stuck there. It's just saying, okay, I'm gonna here's kind of what I see as being really this makes sense for me right now.
Yeah, that makes a lot of sense. And then I think too with it sounded like some of these investors were kind of deciding between it being more active or passive. I guess what were some of the things you talked to people about on that decision, in terms of where I have a couple duplexes, I'm thinking about this. What would you help them kind of work through, if you will?
Well, I think it just depends on what someone's goals are. I ask them, I say, well, what really are your goals? If you have your duplexes, well, how much cash is that producing for you now? And I say, well, if you were to buy a couple more duplexes now, like how much really would that produce for you? And a lot of times we really undervalue our time. So if I'm talking with somebody who's a physician or somebody who's a business owner, their time zones can be hundreds of dollars or even thousands of dollars an hour. So if they're the ones taking calls for this, even if they have a property manager, they're still having to come home and, hey, the tenant didn't pay, or hey, we've got this whatever issue. They're having to deal with all this stuff, right? So I look at it and say, okay, with what you have in this current deal or the future deal, what actually are your cash on cash returns? What is your potential? And most of the time I find people don't really manage things super well. A lot of people I know own stuff, fully paid off in cash. And I'm like, your returns are probably like 3% a year or 5% a year. You could do much better than that, right? And you're really not valuing your time appropriately. If you value your time, you're probably losing money because of all the time you're putting into this, to acquire, to manage, to do property management, all that stuff. So I think those are all considerations that people typically don't really think about. They don't think about, what it looks like to actually, be in the driver's seat. And, most people, I'd say about 98% of people that start in a passive deal, do end up enjoying the process of being passive because it's better returns, but they've got to get used to really being more hands off, right? That's something they've got to get used to. And then some people just say, I just want to be in control. It's like, okay, that's great. You want to be in control. You can absolutely be in control. It's just, you got to understand, you should value your time as well.
Yeah, that's interesting. Yeah, I mean, because that's really, when you think of the whole thing around passive investing, where you're not And you had, if you're buying duplexes and houses as you were, you're not, it's not really, real estate investing is not passive. Like if you're the person that's responding to the management company, you're the property manager, like it's really only passive if you hire that out, if you will.
Yeah.
And that's what you're doing investing as a LP, where you've offloaded that work to Bronson or to me or to whoever, and then it actually becomes passive. So then that's where sometimes another time that's how I'm answering that, this is too good to be true. Like I don't get it. I don't have to do anything. It's like, well, yeah, you basically hired us effectively to do that work now. So it is passive for you, where we're managing every aspect of it.
Yeah, and it's amazing too. There's just no substitute for experience. I mean, you've been doing this for over 15 years. I have over 15 years real estate experience. Like when you get a really good team, you get a really good operator. I mean, somebody that's not their full-time thing to do. They're never going to be as good at it. They're not going to have the right contacts. They're not going to just like, it's amazing when you have the right team. And then when you go after, let's say we're going after a 300 unit apartment complex versus a small multifamily, like there's going to be so many economies of scale that are going to be in there. You're going to get way better management. You're going to have way better everything. It's just going to be so much more efficient from the staff that's there, that they're dedicated only to that property. And there's so much more, I'm sure you have so many examples in your business, Drew, of just ways that you've come in and really, improved operations just because you have the experience with it, right? You can see it, but oh, that's just like this other property. We're going to come in and do this. We've got to fire that maintenance guy. We got to, it's just very clear. Like, okay, what needs to happen here, right?
Right. Yeah. And oftentimes I do think to myself, like we are essentially paying for ourselves in a way. Like, okay, because to your example, this person might have a paid off duplex and they're earning 3%. And then you're going to make more, at least, every syndication, the projected returns better than that. And you're, you don't have to do any work in the syndication option. And then the sponsors more or less, I say to them, like, we're paying for yourself in a way because we're the professionals. We're getting higher returns. I started slowing down. I was saying because it's not guaranteed, I guess, but it's by and large, if you look across probably your average, mom and pop apartment investor compared to the big syndicators, the returns are higher just being an LP and not needing to do anything. So
yeah, 100%. No, it's really true.
Then what other mistakes would you say you see LPs make where I guess one was not valuing their time, but then maybe on what deals they pick to invest in or kind of some of the decisions they make? What would you say are some mistakes?
I would say I've seen some investors, get marketed to, meaning they have some sort of clickbait thing they click and they invest in something that's, either not legit or it's just somebody that I remember I had one investor reach out and say, hey, here's, how does this deal look? And I said, I've never heard of this person. Looks kind of a clickbaity type of thing. Like I kind of watch out for that stuff. Reputation is a big deal. And that's where sometimes you can't really delegate just, hey, who should I invest in or get some hot tip from somebody. It's good to really make sure that that person, that they're well thought of in the industry. So that's one mistake. I say another one for a lot of people, and I would say, I have the opinion that about 98% of people that should be doing syndicated investments or investing in alternative assets such as multifamily or other things that that we're involved with, they're not, and it's just they haven't heard of it or they just aren't comfortable with it yet. And so I think the biggest competition and the biggest challenge for a lot of people is it's either they're just not educated or there's an analysis paralysis. They're like, oh, I should do something, but I just don't know what to do, and they just don't do anything. And so I think that's kind of the comfortable thing, right? Is you just don't make any decision. And so, but it's amazing the amount of learning that happens when people actually get in the game and they start taking action. So I think inaction is one. I think another one, yeah, like I said, is just making sure that the group you're working with is a reputable group. But I encourage people to set a timeline. Okay, I've got 60 days here. I'm going to look, as many people's deal lists as I can. I'm going to ask around. I'm going to, talk to people I know. I'm going to go to meetups and I'm going to find a deal. And in the next 60 days, I'm going to choose one, right? Or I'm going to choose two. And I think putting a small amount of money in a deal, especially if somebody's higher net worth, somebody's got a net worth of $2 million or more, it's like, you could put 100K in a deal, you could put 50K in a deal, and it's not going to ruin you if something doesn't go perfectly or it goes, doesn't go right. So I think those are all things that are important.
Yeah, and then especially, I think getting started, then you're going to see how this really works versus more just having more of these talks. Yeah, that's a great tip. I probably for me, it's actually people. When you're not actually doing the deal yourself, I think as a LP, it's a little hard to see some of the risks maybe. So, I like the list you were going through of the risks, but then what ends up happening is they just the LPs, they return chase. Like they just see, oh, this deal says it'll make a 20 IRR.
Yeah.
I like that. But meanwhile, it's like a office redevelopment deal that's like, it's either going to make a 20 or you're going to lose money kind of situation, when they could have invested in a nicer, newer, safer apartment building or something and made like a safer, let's say 11 or 12%. And then if you didn't do enough, maybe homework, we'll call it, to understand the differences between those two, yeah, why would you not just chase the 20? So that's something that we run into a lot, because we're more of the safer 11, 12% kind of thing. And then we're bumping up into people doing development deals and stuff. And they're like, yeah, this is, I can make more on this. And it's like, sure. Yeah. If they build it on time and the price is right, the costs are the same and they hit the rents and can execute that refi and do all these 20 other things. So yeah, that's interesting, because it's harder for them to understand all that, obviously. But when we're more in our shoes, it's easy to see.
Yeah.
I guess then on your current deals, are you, what are you, I mean, most of the stuff you guys were buying, you said it was multifamily in the Southeast then?
Yeah, mostly Jacksonville, Florida, Atlanta, Georgia. We've got a Huntsville, Alabama property. So we've got about 1,500 units in Jacksonville. That's gone pretty well. We have a little bit in Houston as well. So yeah, mostly kind of Southeast.
And then were those were all like more value add kind of properties, or what? Maybe what's the profile of those?
Mostly value add. I mean, there's one's a little newer, but most of them are kind of 70s, 80s built, and some value add needing. And the good side, or the good part, I should say, of Jacksonville is we're buying a lot of stuff that the last couple of years that has been rents $1,000. The going rate's about 1,500. 1,450, 1,500, and so there's a very high upside in doing a modest 5-6K rehab, which most people don't understand that the value of multifamily is determined by the rents increasing, right? It's not like a comp property or something. It's just how much are the rents compared to other places, and so we're excited about that. It's just working that plan. And that's the ability of the team to execute the plan really is creates stability in the deal.
Yeah, and I think that's a huge premium on the renovation cost. I mean, that's great. And it's been a challenging couple, last 12 months for that profile deal. I mean, how's it gone with, what kind of financing did you do? I mean, insurance has been a tough last couple years. I mean, what kind of maybe speed bumps you guys run into?
Yeah, we've had some headwinds on those. We had, the hurricanes, particularly in Florida, have, really, sometimes 200-300% increase. It's hard to predict that. Labor costs, material costs, 30-50% in some cases. So it's gone way up in some areas. So we have had some headwinds there. Rents are kind of stable or slightly rising. We did, for these, most of them did bridge debt with some, extensions and things like that. So it's been, for the most part, it's been fine. We've got one deal that's struggling a bit, that it's not in Jacksonville, it's in Atlanta. But, I think in general, it really comes down to being able to work the plan within the time you said you're going to do. And hopefully when you go to refinance, you've developed enough value in that property, your income is where it needs to be, and you're in good shape.
And then on most of deals, then you think you'll be at a point where you'll be able to do like a cash neutral refi or sell and still have a good return, or kind of what are you guys thinking for some of those deals?
Yeah, absolutely. The goal really is to either cash neutral refi for longer term, or maybe you're some of them you sell, or it just depends kind of on the situation for the specific property. But really, the margin of safety, is Warren Buffett uses that term, is really in being able to execute the plan. If you can effectively execute the plan, you've renovated 50 to 80% of the units within those 2 years, you should be in good shape. And you should be, as long as your occupancy is 80-90% or higher, you should be okay. But again, every deal is different, and sometimes you're way ahead on renovations, but that reduces your occupancy. And so, it's just the balance that I'm sure you guys work with too, where you're trying to maximize that. And nothing really, a lot of investors think, oh, things just go exactly according to plan. Like nothing ever goes according to plan. Like it always goes different than its plan. And so how do you navigate that? How do you walk through that? And I think it's good to to walk through that in the way that the best way you can. So.
Yeah, that makes a lot of sense. What kind of deals are you looking at going forward then? Are you guys sticking with all multifamily, or what? I know you're talking about ATMs and car washes too. And what's the I guess maybe what's the next, 12, 24 months look like for you guys?
Yeah, so we have looked into other types of stuff. The last few years, I started getting into some of the ATMs and other things a few years ago as a passive investor. We love being in things that cash flow. I think if you have appreciation or cash flow just in general as an investment, I think cash flow wins every time because you can leave your job with cash flow. If you're going to make a lot of money someday, it's hard. You can't really leave a job with that. You can't replace expenses. You can't really support your lifestyle. But I think that, by having cash flow, you can. So, the ATM deal has been an awesome, consistent cash flow deal. Car washes, some of the private equity stuff, oil and gas, amazing. Also some tax advantages there as well. So we look at that alternatives, and we're very, picky on who we get involved with. And, we just like being with groups that are reputable, that we have a great experience with. And, it takes time sometimes to flesh out who the good players are, who the people are that are good, and those that aren't. So, but no, we're really excited about it. We've got some exciting stuff planned for this year and the alternatives.
Nice. And so, what kind of so cash flow is the number one focus? I mean, right now and just probably forever, given how you answer that.
I would say cash flow, and then also, appreciation's good. It's good. It's just, we've seen, it's particularly in some of the, the stuff with bridge or other types of lending, or even just some areas where it's cash flow that was really good is really dried up. And it's understandable because of these costs and other things have changed. It is a funny time for some deals right now in multifamily. But for what you can get by investing in some alternatives or even other businesses or things like that, you can get things that have pretty consistent cash flow. And I think that's, to me, I have a bias, toward cash flow, just creating things. How do you create something that is going to generate, more wealth over time? I actually have a book coming out in October. It's called Fire Yourself, Replace Your Working Income with Passive Income in 3 years or less. Right. So how do you do that? Right. If you're trying to leave a job, you're trying to replace, maybe somebody has a business, you're going to sell it. Well, how do you generate, income? And there's a lot of ways to do it. And I think it's just learning how to do it and getting some experience with it. It just gives you tools that, I just think it helps people to get where they need to go.
Makes sense. Yeah. I think you have a great point. Yeah. You're not going to be able to quit your job on appreciation, and unless you're selling everything every couple of years. But yeah, and also too, especially in today's times where, it's, the next year or two is pretty unpredictable. Yeah. So the term that I've been using on some of our stuff that has strong cash flow, it's about getting paid to wait. So we don't know where it's going to go. I was saying the same thing in 2009 too. So it was like, we don't know how long it's going to take, but the cash on cash is great. Let's just do it. That was my whole pitch. So bringing that one back out, I guess, here, yeah. Whatever, 14 years later. So, I definitely, agree with that. So cool. Yeah, let's leave it there, Bronson. This was really, really interesting. So then how can listeners, viewers get in touch with you or find you if they want to hear more? Yeah.
So we have a free download. They say inflation officially is 3.2%, at least the time we're recording this, late August, but I think it's more like 10% or 12%. I think it's much higher. There's an ebook I have on my website, bronsonequity.com. It's called How to Use Inflation to Your Advantage. So there's some kind of creative outside the box using various alternative assets and debts and precious metals and different things that you can do that you probably haven't heard. So that's at my website, bronsonequity.com. And I also love, we love getting new people on our investor group and just learning about, what their goals are and helping them along the way.
Great. All right. Yeah. Awesome lessons in here. Thanks again, Bronson.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.